we're pleased to have Kevin Gluck back at eState Academy, and we're lucky to have him. He's a cross-border specialist and one that I use regularly whenever I have U.S. issues. And you'll recall that we've spoken before about what to do when you have a U.S. beneficiary, what to do when you have clients with U.S. assets, and now we're going to complete the trifecta and deal with what do you do when you've got a U.S. citizen client, even though they're resident here in Canada, and there's special planning that we need to consider. And so for that, we've got Kevin. So over to you, Kevin.
Thanks, Jordy. Yeah, sorry, you can hear everybody good now. So yes, so today we'll cover in some things we're not going to get in the weeds on, and you can follow up with me anytime. But we're going to focus on planning for the U.S. citizen client. Brings in some of the same issues that we talked about for the beneficiary, but this will be a little more focused on the wills and the planning when we've got U.S. citizens in Canada. So kind of just again, for some of you here last time, sorry, we'll just kind of give a quick summary of what our estate tax situation is. And this, I think, kind of accurately sums up the political situation in the U.S. right now. But so kind of where are we for this year on the estate tax side? Because for U.S. citizens are subject to an estate tax and a gift tax. So it's different than Canada. So the exemption for a U.S. citizen, and this applies no matter where you live. So in Canada, the U.S., Uganda, Asia, it doesn't matter. It's all the same. It's about a little under 13 million for a U.S. citizen for the gift and estate exemption. So again, for people that don't deal with this a lot, what that means is if you're a U.S. citizen and your estate is above that amount, you're going to have to file an estate tax return. And unless you're leaving your assets to a spouse or to charity, so say a second death, anything above that's going to be taxed at 40% on the value. It's not a gain tax. So right now, this is the all-time high as it's ever been. You've got about 26 million for a married couple. This is going to be inflation adjusted. We don't have the numbers for next year, but the preliminary estimate is about 13.5 million per person. So again, this is based on value. So it's 40% of the value. It's not a gain. And one thing I note is this is going to sunset in 2026. So if nothing changes, the exemption is going to go back to where it was, about 6.5 million. So we'll see what happens with the election. We'll see what happens with the presidency and the Congress. But one good part is the IRS has ruled that even if the exemption drops and you made transfers, they're not going to claw that back. So the kind of one thing to think about is use it or lose it for high net worth U.S. people in Canada. So one thing to consider is if you got really high net worth people, 30, 40, 50, 100 million or whatever the case may be, they're always better off using that exemption and getting it out of their estates. So that's one thing to consider here on the U.S. side, transfer assets to the next generation. But of course, just, you got to be wary on the Canadian side if you're going to be giving appreciated property on the income tax.
Can I just stop you just for a second?
Yeah, sure. Yep.
Just so people, especially if people aren't that familiar with this is U.S. dollars. So
yes,
the value is U.S. dollars, but the assets, they're not just U.S. assets. Just to make that very clear, it's worldwide assets. Whether you own any U.S. situs assets or not, it's a worldwide valuation, right?
Yep. Yeah. And I'm going to be covering that a little bit, but that's a great
Okay,
segue.
sorry.
Great point. So in just a couple of things here on the U.S. citizen side, just that we have the gift tax, right? So this sometimes confuses people. These gift taxes there to prevent people simply from giving away all their assets before they die. And then people read things online and they hear about this annual exclusion and think that there's tax owing if you gift more. So I just want to cover these briefly. So the gift tax exemptions, again, this is for U.S. citizens. So U.S. citizens, no matter where they live, and also, if you were a U.S. resident, U.S. domiciliary, this would also apply to you. So the annual exclusion for this year is $17,000. What that means is if you're a U.S. person, you can give away $17,000 per donee to as many people as you want, all your children, all your friends, to Jordy, everyone you want. That is basically a freebie to use your lifetime $13 million exemption or estate tax exemption. It doesn't affect that at all. If you give more than that to a particular person, all that means is you would have to file a gift tax return to report Anything over that is what we would call a taxable gift. There's no tax owing. So a simple example, you give your child $20,000. The 17 is a freebie. You've made a taxable gift of $3,000. The correct filing in the US would be a gift tax return, Form 709, and you would report a $3,000 gift, which would chisel away $3,000 of your $12.92 million lifetime gift tax exemption. So for most people, big deal. So the point of it being, just so you know, like, so I hear people all the time say, well, I can't give more than 17,000. I'm going to pay gift tax. That's only for someone who's given away $13 million already. So just something to think about there. When you've got spouses, you can, both US, you can transfer unlimited, doesn't have any effect. One thing I want to point out here, this $175,000 annual exclusion for gifts to a non-citizen spouse. So here's where this comes up. Married couple in Canada, one's Canadian, one's US. When we do planning with often to avoid the capital gain, the amount on the principal residence in the US, because it's tax-free in Canada, not tax-free in the US, we often will transfer the US citizen spouse half of the house to the non-citizen. For the US, in the US, you get $175,000 freebie if it's your spouse, and then the balance would use that exemption. Again, there's the 13 million exemption. And then just a quick point, not today's topic, but for non-residents, so pure Canadians, all they get if they were transferring a US asset is a $17,000 exclusion, and that's spousal. So again, here, this top column for US citizens, this covers gifts of anything. It doesn't have to be in the US, can be cash, can be no matter where it's located. So just a quick note here, something to think about. We've got the sunset kicking in 2026 if Congress doesn't pass anything different. So just when you got the high net worth people, think about maybe utilizing that exemption in the next 2.5 years, depending on what it looks like in Congress. So here, I just want to get into a little bit more detail on what the estate tax covers. Simple here, just if you can't read what the t-shirt said, is I paid taxes all my life and all I got was this t-shirt, and that's the IRS looking for the t-shirt. So, what we like to say here, and by the way, this is from, everyone talks about the estate tax, and this was Trump's advisor indicating that, only foolish people pay estate tax. That's not true. A lot of people pay estate tax. There are many techniques to reduce it, but, unless you're going to be, making big gifts to charity or things like that for the really high net worth, you're likely going to end up paying some tax, but many, many ways to kind of plan and reduce it depending on the situation. This is kind of where Jordy was talking about earlier. So for a US citizen, okay, on their death, this is basically all the schedules from our estate tax return. So as you'll see here, this covers for a US citizen what you're subject to estate tax to, essentially everything. So it covers anything you own, different categories, real estate, stocks, cash, also covers insurance, which don't people think about, joint property, okay, transfers during your lifetime. We have our revocable trusts, and I'll get into more detail on this, but people that set up trusts and make transfers and retain interest in it, those are included. Schedule H, which I'll talk about in a minute. This comes up with trusts that are set up for people, powers of appointment, annuities, IRAs. So think of it this way. The estate for US estate tax is basically anything that a person had an ownership interest in or is deemed to have an interest in because of retained interest. So it's not just the probate estate. It's any non-probate asset, whether they're bank accounts, retirement, insurance, all of that is generally included. And it also covers some unusual things, which I'll talk about, which are things that, trusts that are set up for a person, trusts that they set up that they may have powers over. So the big thing to think about remembering when you're talking about the estate and their exemption and what the assets are is this is going to basically cover any possible thing that you could think of. Two things here. So this one is our famous 2036 and 2038. So just remember, keep in mind, this would cover like your alter ego trusts, for example, or for example, a freeze trust where you have US people that, are beneficiaries and trustees who made transfers to the trust. But the concept of this is just because the person doesn't own it, if a US person makes a transfer to a trust and they retain power, control, or an interest in the trust, generally speaking, subject to exception, those trust assets can be includable for estate tax purposes. In that second one there, you'll see 2038. These are our common revocable trusts, essentially, which are treated basically as ownership, outright ownership for our purposes in the US. They're probate devices. But again, this would be similar to your alter ego trusts, that type of stuff, or like a bear trust arrangement. So again, just remembering that, if you've got things that aren't in their personal name, but there's trusts in which they set up or they're a beneficiary, those need to be part of the calculation when you're doing the planning. And I just mentioned this one here because this comes up all the time, and this is part of like the US planning. So what we'll often do is typical situation when we've got high net worth family and US children. So it could be US parents or doesn't have to be. But when you've got like a US beneficiary with a trust that's set up for them, if they're their own trustee, which is common here in the States, but if it's drafted without any US planning, so that they have basically unlimited discretion to withdraw the funds, those trust assets will be includable in that US beneficiary's estate when they die, just because it's treated as we would call a general power of appointment. So a common planning thing that comes up when we're doing planning are looking at trusts that other family members set up for, US citizens in Canada, whether it was from the parents' will, the mother's will, the grandmother's will. Because the drafting is different, a lot of times, you'll have to keep in mind that trust might be includable. It's something you kind of talk about with US counsel. But again, just an issue to spot there. So to avoid this, one kind of like bedrock part of the US citizen planning, when you've got US citizen clients, whether there's a spouse or children, are kind of this bypass trust concept. So it's the same kind of concept that I was just mentioning, but drafted so it'll provide US estate tax protection. So on the first death of a married couple, you could structure like a spousal trust that would qualify in the spousal trust for Canada, but will be drafted so that when the surviving spouse dies, none of those assets will be included. And you'll see here with many of you who I've worked with, you'll notice the kind of the similar concepts. When you've got like a spouse who's the trustee and the sole beneficiary, they can make, they can get all the income, they can distribute capital. When they make distributions to themselves, it has to be under these tax regulation components. You'll see there that HEM standard, but that sounds limited, but I would say that, it's geared toward keeping someone in their standard of living. Wealthier families have a higher standard of living. So it's probably broader than it sounds. And we often would add an independent trustee in there so they could appoint like an advisor or a friend who can make a capital encroachment for any reason. So these are kind of similar concepts you would see when you're planning for US citizens between a married couple, and also very commonly when you're leaving it for, when there's big inheritance coming for US children. Jordy, any questions so far? I can kind of go through the
Sure.
structure.
So I think you're going to show that here, but
Yeah.
for a spousal trust, we have to have mandatory payment of income to the surviving spouse. Does
Right.
that pose a problem under US?
No, not at all. And that we would typically structure in the cross-border context exactly the same way. So you'd have the spousal trust. I mean, he or she would be the only beneficiary. They'd get all the income. The capital distributions would need that US adjustment, at least on the spousal beneficiary. But no, that's how we would typically do it. If they weren't living in Canada, you might often see the bypass trust be completely discretionary, and they could distribute to to themselves, to the kids. Here, so this is kind of, I know this is a little, a lot of diagrams on here, but so this would kind of be what you would typically see: US citizen spouse couple in Canada, higher net worth. So estate tax is relevant. If you got a small estate, it doesn't matter. You could leave it outright. We're not worried about anything like that. But where we've got people who are looking at paying estate tax, and this is going to kind of tie in what Jordy was saying. So you'll see here what basically the kind of breakdown of this would be that, we've got an exemption now of 13 million roughly. So what you would typically see is that bypass trust for wife. So that would be the spousal trust, typically with just a spouse, pay out all the income. That would hold the estate tax exemption amount. And then that would completely be exempt from estate tax on the survivor's death. And then accompanying that would be a separate spousal trust. So similar to the Canada, what the US system is, you have your estate tax exemption amount, and then anything above that. So say you had a spouse with $20 million, the first 12, 6, 13 million, whatever the exemption is, will fund that bypass. And then everything else, if you want to get a deferral, so even if you're Bill Gates with 70 billion, it has to go either outright to the spouse or in a spousal trust, very similar to yours, where the spouse is the beneficiary, gets all the income, all that stuff. So that's the kind of similar kind of a structure that you'd see here. And then you'll kind of note there on the left side, I would just note when you've got high net worth people in the US and there's big insurance, we often set up what are called insurance trusts during someone's lifetime to keep the insurance out of the estate, subject to estate tax. But so this would kind of like be the general picture for a high net worth US citizen couple in Canada when US estate tax is relevant.
Can I just make one point? Because last week we talked about life insurance trusts, but you're talking about an inter vivos trust that is the owner of the life insurance.
You're correct. Exactly right. So in the US, what's common, less common in Canada, but that's what we certainly do them, is like, I know you guys kind of put that life insurance trust planning in the will, which doesn't really work on our side in the US. But let's say you've got a US citizen couple with a $5-10 million insurance policy. That's subject to estate tax. So even if it's like tax-free on the first death, that's going to be a big number in the second death. So in the US, you would set up like an inter vivos trust structured similar to the will. You'd have like typically the spouse would be the trustee, spouse and children are beneficiaries, and it would probably kind of flow similar to the will and could be combined with those assets later. But the point is, the trust is the owner of the policy and the trust is the beneficiary. And by virtue of doing that, you've removed ownership from the decedent, which means it's not even subject to estate tax.
Right.
So that's the big benefit there. Okay. So that's kind of looking at, you've got the US citizen, kind of 2 US citizens, and I'll kind of move it along here. This again, so when the kind of looking at a diagram of like when you've got a US citizen spouse and the second and the survivor isn't a US citizen, maybe they live in the US or maybe just one's a non-citizen, it would be a similar structure, except that on the marital trust portion, which I just wanted to mention, in order to get that estate tax deferral, you can't, it's not just an unlimited amount if they're not a US citizen. You would, if it's a larger estate, you're going to need to make a what's called a QDOT, a qualified domestic trust election, which is a little more bells and whistles. You're going to need a US based trustee, oftentimes a bank, and you'll need, some security for it. So there's a lot more involved in that, but at least it will allow, no matter how large the estate is on the first death of a US citizen decedent, to defer the estate tax.
So can I just
sure.
Just go back to that slide? So the idea is the US citizen is dying first, has an exemption, and in fact if the spouse was a US citizen, they'd have double that exemption. But because they don't have double that exemption, we need to deal with that amount X in excess of the base threshold. Is that the idea?
Yeah, that's right. It is one clarification. So even if the spouse, like if it was a US citizen spouse, no matter how large the estate is, like say if it was a citizen, there's 100 million going there, because they're a US citizen, an ordinary spousal trust or an outright disposition will qualify for the deferral. But if the spouse is not a US citizen, to get that unlimited deferral, you have to make a QDOT election on the estate tax return. And just to mention here, again, just for the familiar, like that's for bigger estates, you have the marital credit under the treaty. So you'd basically, if it's a smaller estate, we're meaning probably an estate no larger than twice the exemption, you can use the marital credit under the treaty to get that deferral without doing the QDOT, but you can't do both. So meaning that if you had an estate of 26 million, you could use the bypass trust and the marital credit without making the election. But if you had, let's say, 50 million, the marital credit's not going to be enough, and then you want to consider the QDOT. So it's one or the other, the treaty election or the QDOT. And real quick here, I know it's in the topic, but if you've got the Canadian spouse dying first, it's that bypass trust concept that we want to go in for the US citizen spouse. All income, discretionary capital, limited by that standard. So that's the simpler planning when you've got the Canadian spouse dying first. And this is just real quick, you know, again, a little more detail on that QDOT when you've got, again, this is a U.S. citizen dying and their spouse is not a U.S. citizen. Again, if you want to get that marital deduction for anything over the exemption, it's a spousal trust, but there's some special elections you need to make. You know, you need a U.S. trust here. The requirements are similar to the spousal trust in Canada. You know, only the spouse is the beneficiary, but you'll see the QDOT requirements. There has to be a U.S. trustee, and unless there's like a bank acting, there has to be security, a bond, or a letter of credit. So there's a lot of hassle around it. But when it's needed, it will, at least it will allow the unlimited deferral.
Can I just ask then,
Yeah,
just to go
sure.
back to this,
Yeah.
just if I'm acting and I see, okay, I've got a U.S. citizen client, I'm going to think about values, right? And so if they come in and the combined value of their estate is, you know, and including it, life insurance and all that, it's a couple $1,000,000. Okay. Am I going to worry about this, or what do you think I should do in that situation, Kevin?
Yeah, I mean, I don't think you have to get worry about this type of stuff. I mean, if it's a couple $1,000,000, I think you could probably just keep it very simple. You probably don't even have a bypass trust if you're talking about $2 million, and just kind of, you know, if something was going to change on the U.S. side. I think once you're talking about the combined assets being over the exemption amount, you'd at least want to build in the concept of, you know, the bypass trust planning. Like, if, you know, it looks like you could, if the total assets could be exceeding, you know, 6.5 million US, which with the exemption might drop down to, you at least want to consider some of these components. QDOT, you wouldn't really need to be worried about. And just so you know, like with this QDOT stuff, what we typically do is we just have regular spousal trusts in the will, which would incorporate, you know, kind of the normal planning you'd see. The QDOT's a voluntary election. So we usually what I do is put these provisions in the will, and it allows that if election is ever made, these are implemented, you may never use them. So, you know, for real small estates, a couple $1,000,000 to run, I don't think you need any of that. But when you're in the estate tax realm, it does, and you've got a non-citizen in there, at least it's helpful to have it in. And again, it's a decision that can be made post-mortem on the return. So you don't even have, it's just an option.
So because this is really important, I think, for us, is when do we need to get somebody like you involved? I mean, right now we're talking about 13 million US, let's just say. There's a good chance that that's going to come down by 2026. If it comes down to $6 million and you include, you know, jointly held property and life insurance, and it's pretty easy to hit that number for many people. But I guess the point is, you could say, listen, come back to me then, and we can update it based on those thresholds. What are your thoughts on that?
Yeah, I mean, I guess I would say, like I said, you're talking about $1 million or $2 million total net worth. You could keep it very simple. You know, once the total assets are close to like what the one exemption would be, I think at least to have the discussion, just so they know, because if they have an outright will, and then they're over on the second death, there could be estate tax. And then, you know, even if they're paying, you know, 40% on $1 million, I mean, that's, you know, that could have been avoided. So I think if you're close to like where the exemption level is combined, it's at least worth the discussion. You don't need all of these bells and whistles that I'm talking about. And the other part of it is just so people understand, you know, even if it's not going to be a big estate, there's other income tax, like, you know, our foreign trust rules for US people, that even if you're not dealing with like estate tax or income tax concerns. But on the estate tax piece, I think if your combined assets are hovering around where one exemption is, it's at least worth it to have a discussion, just so they understand, because once you have a simple will, once you're over, you know, and there's one spouse left, there's not, you know, you can give assets away, certainly. But then you're looking at, you know, an estate tax situation. So that would be my rule of thumb, I think. You know, sometimes I do calls and be like, hey, you know, I can keep it simple. You don't really need anything from me. And, you know, but I think when you're hovering around there, it's at least worth a discussion.
And just for those who use eState, you'll know that eState does warn you about these issues. When it sees that you've got US citizen clients, it'll warn you. And then in the reporting letter, it'll cover this off as well. So, and Kevin, we've got about 3 minutes left. If you want to summarize, I think the theme really is, if you've got US citizen clients. That's an important thing to know.
Yeah.
So I'll leave it for you to summarize.
Yeah, and that's it. I mean, a couple of quick times I was going to mention. I covered these in a little detail last time, but just again, when you've got U.S. citizen clients, a couple issues just to think about, and obviously, sometimes people don't realize they are U.S. I just mentioned here, so usually the people will know if they're U.S., but if they're U.S. people in Canada, I'll just note one quick fact: if the kids are born in Canada and one of the parents is U.S., the kid still could be U.S. So you'll note there. So for children born after 86, if the U.S. parent lived there for, 5 years after 2 after the age of 14, that Canadian child born in Canada could also be a U.S. citizen. I would just also mention, holding company, freezes, these type of things. If your clients are U.S. and you hear, well, I've got a holding company and an operating company, we're going to do a freeze. That is something they're going to want to get U.S. advice on, because that's fraught with all kinds of complications for U.S. people. And then the last thing I just mentioned is, this has been very busy. Is for people that get, oh, I'm sick of all this hassle and filing all these tax returns. Expatriation is an option. I mean, the wait line in Toronto now, I think, is about 2 years to make an appointment. Some of the other consulates like, Calgary, Halifax are shorter. But you're probably still looking at least a year for a lot of them, unless you want to go to the Caribbean. But, the bottom line is that is an option. Just one thing to keep in mind there. If you're not a dual citizen at birth, we have an exit tax if you're over 2 million in net worth. So for people that are considering that, you've got a long wait to make your appointment, but you don't want to be subject to the exit tax. You got to get down to the 2 million. You can use that gift tax exemption to get down there. But that's something to keep in mind. So, that's an option. We can drill down on that, on a separate call, but, you need to be compliant, and the exit tax kicks in at over 2 million. So happy, Jordy, take any questions or anything like that. If anyone, wants to discuss anything, happy to take it.
I just want to maybe just summarize, about when we got to worry about this. We've got a U.S. citizen client, and they've got some money there that's approaching the exemption amount. That's the time to get, as far as I'm concerned, I sort of say to the client, listen, we should talk about U.S. planning. Let's get a U.S. cross-border. I use Kevin. I recommend Kevin. But there are lots of U.S. advisors, and
Sure.
and get that issue at least covered off, because we're not qualified. At least I'm not qualified to give U.S. state tax advice. And so, important when we see this, that because it's not a joke, I guess, like 40%, of value, a wealth tax. It's a wealth tax, right?
Sure.
40%
No question.
is a big number.
For sure.
So,
Yeah. And so thanks, Jordy. And like any follow-up questions, Jordy, you can circulate my contact info. I'm always happy to, have people bounce something off me, or, even if it's a quick informal thought. So happy to always be as a resource to anyone for eState and for Jordy's crew here. So thanks again for having me.
Thank you, Kevin. And
Appreciate
everybody coming next week. Ian and Susanna are leading our webinar on joint tenancy issues. So hope that you can all make it on Thursday, and we'll see you again. Thanks, Kevin. Thanks, everybody. Have a good weekend.